Good day. The purpose of this podcast is to explain the basic concepts and principles of transfer pricing. A transfer pricing system is normally implemented by companies with more than one division, which are managed by independent management teams, and these divisions require products or services of each other. The price or cost at which the divisions sell or buy these products as is referred to as transfer price. These divisions can also be departments, subsidiaries, cost centers or investment centers, depending on how a company structures its operations. Transfer pricing systems can have a significant impact on performance measurement, especially if it is based on profitability. This is because the transfer price will be revenue for the one division and cost for the other division. Therefore, it is important that the transfer pricing system motivate divisional managers to act in the best interest of a company and not just the division. How do we then determine the transfer price? There is a number of alternative transfer pricing methods which we can use to determine the transfer price. For this module, we are focusing on the following three methods. Market-based transfer prices. With this method, the transfer price is the prevailing market price plus or minus internal savings if there is any. Marginal or variable cost transfer prices. Using this method, the transfer price is equal to the incremental variable cost. Marginal or variable cost plus opportunity cost transfer prices. The transfer price is the incremental variable cost plus opportunity cost on sacrificed units. In a transfer pricing scenario, always read the required carefully to identify from whose point of view the question is. Is it from the buying or the selling division's point of view? We will now look at how these methods are applied in the buying and selling division. For the buying division, the maximum transfer price will be the market price plus the internal savings per unit. The minimum price will be as low as possible so the division will be profitable. This is not covered in this module. For the selling division, the maximum price will be the market price per the unit minus internal savings per unit. The minimum price will depend on whether there is a perfect market, an external market, or no external market. And for no external market, the total transfer price will be the total incremental cost per unit plus negotiated profit margin. For the external market and spare capacity, the transfer price will be the total incremental costs plus the opportunity cost divided by the total units transferred. For the perfect market and where there is no spare capacity, the transfer price will be the market price per unit minus internal savings per unit. The availability or not of spare capacity also affects this transfer pricing. Should a question not give enough information regarding the markets, use the general rule. The general rule is the minimum price will be the incremental costs plus opportunity cost of the transferring item. Remember that opportunity cost is the contribution on lost sales units only. How then does opportunity cost arise? If an external market for the product exists, we must first establish if there is enough capacity to satisfy both the internal and external demand. If the capacity is not enough, then the external market units must be sacrificed to meet the demand. This sacrificed units gives rise to aforementioned opportunity cost. Let us have a look at an example. A paper company has two divisions, the paper manufacturing division and the distribution division, which distributes paper from PMD to various customers. The manufacturing division has the following costs and capacities. The required is to determine the minimum transfer price per box that the paper manufacturing division will be willing to transfer to the distribution division. From the scenario we've established, the question is from the seller's point of view. We also identified that there are a total maximum capacity of 20,000 boxes. Of this, 17,000 boxes is for the external market. This represents a spare capacity of 3,000 boxes, which is less than the required 4,000 boxes. This means that 1,000 boxes needs to be sacrificed from external sales. Now that we are in a position to determine which method to use and the cost to include, from the above we can conclude that we can use the variable cost plus opportunity cost transfer price method. Remember that the question asked for a transfer price per box. You must always answer the required to maximize the marks in your assessments. Let us start with the incremental costs. You'll have variable costs of 35, direct labor of 20, direct material of 20. The external variable selling cost is not applicable because it is not incremental as it applies only to external sales. Therefore, your total variable cost per unit will be 75 Rand. The total incremental variable costs will be the 75 Rand times the 4,000 units that needs to be transferred. That equals 300,000 Rand. To calculate the opportunity cost, we need to calculate the lost sales. Therefore, we need to take into consideration the maximum capacity, our external sales, what is our spare capacity, and what needs to be transferred internally. If we do the calculation, there will be lost sales of 1,000 boxes. The opportunity cost is calculated as follows. Your selling price is 120 Rand. Variable cost that we've calculated in the previous slide was 75. Now we are taking into consideration the external variable selling cost because we are talking about external sales now. Therefore, your total opportunity cost per box is 25 Rand. The 25 Rand times the 1,000 units that will be the lost external sales equals to a total opportunity cost of 25,000 Rand. Therefore, the total transfer cost is the 300,000 plus the 25,000, which equals the 325,000 Rand. The total units that must be transferred is 4,000 boxes. Therefore, the minimum transfer price per box will be the 325,000 divided with 4,000 units. This equals 81 Rand 25 per box. I trust that after reading the script and listening to the podcast, you have a better understanding of the basic principles of transfer pricing. Thank you for listening.